Greetings, grade 10s. I'm going to be going through a question on financial statements in this lesson. So be ready for adjustments, income statement, and some notes. Okay, so I'm going to be going through the question and then looking at the memorandum. And hopefully a lot of the stuff is familiar to what you've been doing in class. So the first question is some multiple choice questions, and this should not take you long. The GAAP principle that requires us to do adjustments at the year end for accounts still due and monies receivable is prudence, consistency, matching, or going concern. Okay, hopefully you've already identified the answer here. Are you happy with C, matching? I'd agree with you that C would be the right answer. Okay, please feel free to pause the video if you're still thinking or need a little bit more time. Number 2, which item will not appear in the pre-adjustment trial balance? Vehicles, interest expense, accumulated depreciation, or accrued income? Chosen your one? I would go with D. Income accrued or accrued income is an adjustment entry, so would only occur at the end of the year and wouldn't be in a pre-adjustment trial balance. Third one, the GAAP principle that requires interest paid on the current account overdraft to be shown as a separate entity in the income statement. Have a look at those 4 options. Right, materiality. Are you happy with materiality? Materiality says that big and important enough accounts need to be shown separately and get their own name. In a business that uses 40% markup, the owner takes stock selling price of 70 Rand for his personal use. What effect will it have on the accounting equation? Well, first of all, we must remember that an owner can take stock at cost price. It's one of the perks of being the owner of the business. So applying the markup of 40%, 100 over 140 times 70 would give you an answer of 50. So that narrows us down to either A or C. A or C. Which one do you think? The answer, of course, is A. Assets will decrease because trading stock's going down, and owner's equity will also decrease because drawings has a negative effect on owner's equity. So you've got hopefully 8 marks in the bag, C, D, A, and we're ready to move on to the more important question. Question 2, financial statements, amounts to 72 marks and asks us to look at the following. Abongi Traders, it asks us to do the income statement for the year ended 30th of June 2012 and do 5 notes. Inventory, owner's equity, cash and cash equivalents, trade and other receivables, trade and other payables. So there are quite a few notes we need to do here. Just remember that for every entry we're about to do, there are 2 places that the entry would need to go. Because we are only asked for the income statement and some notes, there might be cases where we are not really asked to do the other half of an entry. Maybe because it's going to go directly in the balance sheet, or maybe in one of the notes we're not asked. So although it's still required, it's not in the list of things we need to do. So it's happening, but just behind the scenes. So moving on, we first have to be aware of the financial year that we are dealing with. So our financial year ends at the end of June 2012, which means it would have started on the 1st of July 2011. We have to match all figures to the financial year in question. There's the balance sheet account section items. Nothing there is too unusual. It's all accounts we've met and used before. And then looking at the nominal account section, we have got a bunch of incomes and expenses, also items that we would have dealt with before. Just bearing in mind this entry over there, sundry expenses includes bank charges. So if you have an adjustment that requires bank charges to be used, you would go to sundry expenses. Are you ready? Right, here we go. Adjustment number 1. A. Lukomo, the owner, took stock at a cost of 350 Rand to advertise the business at a local fundraiser. So we have to now process this adjustment and take the 350 Rand to where it should go. Think about it. Right. First of all, because we're taking trading stock of 350 Rand, stock is in note number, well in this case, note number 1, inventories. So the first line is dedicated for trading stock. So under the first line, we'd have trading stock written, and then we would write what its opening value is. So from the list of pre-adjustment figures, we'd be able to say possibly that it was sitting at an amount of, let's just remind ourselves, trading stock was sitting at 12,470. Okay, so it's going to be subtracted from trading stock here, 12,470 we said, minus, and the amount in the question was 350 Rand. The other 350 Rand will go to donations. Now because we are, or advertising rather should I say, hey? Advertising is one of our list of expenses, so we'll be able to see that advertising started, just before I reveal everything, it started in our pre-adjustment trial balance with an amount of 12,850, and now we're adding 350 Rand because there is more advertising that the business has done. Happy? So adjustment number 1 has been done. We sent it to inventory or trading stock and to advertising. Number 2, the telephone account for June 2012 must still be paid, 1425. So where does this go? Obviously it goes to telephones. So telephones would need to go up by 1425 because it was short. We hadn't yet taken into account the last month of June. So 16,430, what we started with in the pre-adjustment, plus another 1425, and this is the last adjustment that will affect telephones. We can put the total in our final column. Because this is an expense that hasn't yet been paid, we're also going to go to the note trade and other payables. Now, I'm sure you remember the first line is reserved for trade creditors, which is a fancy name for creditors control. And then after that would come expense accrued, right? It's expenses we are still to pay. You do not have to write telephones in brackets, but I'm just reminding myself that that's where this adjustment has come from. Happy? So the second adjustment done, sent to telephones and sent to expense accrued. Number 3, the business paid an amount of 3,660 for 6 adverts. Okay, so let's just stop. If we had to take 3,660 and divide it by 6, it would give us an amount of 610 Rand per advert. It says that these adverts were shown on the following dates: the 20th and the 27th of June, which would have been in this year, and then the 4th, 11th, 18th, and 25th, which would have been next year. So 4 out of the 6 would be in next year's books. So having divided 3,660 by 6 to give 610, we would now times it by 4 to get 2,440, which is the expense prepaid. Did you get that? So, looking at our information, we know now that advertising would need to be changed. So, you can see my adjustment here. We are going to subtract 4/6 of 3,660, which ultimately means subtracting 2,440, because that is an expense prepaid falling into the next financial year. That's advertising done. We can total it and put the total in our column. 2,440 is expense prepaid, as I've said. That's going to go into the note trade and other receivables. Once again, you know that the first line is reserved for trade debtors or debtors control, and the next line following that could be prepaid expense, or we could call it expense prepaid, and that's where the 2,440 is going to go. Number 4, on the 17th of June, which is during our year, the business wrote off the account of S. Sofuti, which was overdue. In other words, we wrote him off as a bad debt. But on the 24th of June, we received 242 Rand from him and incorrectly recorded this amount in the debtors control account, and we are asked to correct the error. So, when we wrote him off, what would we have done? We would have processed bad debts and we would have reduced debtors control. He is now no longer a debtor. So when he walked into our shop a week later and gave us 242 Rand, it was wrong of us to put it to debtors control, thereby reducing debtors control. If he wasn't a debtor when he came to give us the money, we should not have reduced debtors control. So to correct the error, it means we are going to have to take what debtors was 9880 and add back 242 Rand, because we shouldn't have brought it down in the first place. What is his money of 242 Rand? It should have been processed as bad debts recovered. Bad debts recovered is an income. Over there, it's one of our last incomes. And there was a little bit of bad debts recovered already in our pre-adjustment trial balance, 6760, and we're adding another 242 Rand to it. So we can put the total in our column. Number 5. We have let the buildings out to tenants since the 1st of February 2010. Right, let's just be careful. The 1st of February 2010 is before our year started. Our year started, remember, on the 1st of July 2011. So if we started renting out the building on the 1st of February 2010, it means that this tenant has been with us for the whole year. It does, however, say each year on this date we increase the rent by 10%, and the tenants have already paid the rent for July. Right. So this is the most difficult adjustment we're going to find in this activity, and we're going to have a close look at rent income over there. So rent income is sitting at 73,984. Now how many months would 73,984 represent? It's going to represent 13 months, because we've already received money for the month of July. So there's going to be income received in advance or deferred income, but we need to work out the figure. So it requires us to do a bit of a calculation. First of all, before I go to my calculation space, if we increase the rental on the 1st of February each year, how many months would have been at the old rate and how many months would have been at the new rate? That's what this question is all about. So if we go look at some space that I've got for rent income, we'd be able to make this first statement over here. Here it comes. 73,984 would be 7 of A, and you could use A, you can use X, whatever variable. 7 months at the old rate, being July, August, September, October, November, December, and January. Then on February, we increased it by 10%. So for the months of February, March, April, May, June, and remember July as well, 6 months, it would have been at an increased rate. So in brackets here, it's A, the old rate, plus 10% on top of A. So you are increasing your old rate by 10% and timesing it by 6, because there are 6 months at the new increased rate. Altogether, there are 13 months that we've received rent income for. The next line of our calculations, if we had to times that 6 into the brackets, a bit of maths here, you'd get 6A, and you'd get 6A over 10. Or you'd get 60A over 100, but you'd be able to cancel some zeros. Right? Gathering the like terms on the right-hand side, you'd get 73,984, our total rental, equaling 136A over 10. Or another way you could see it would be 13,6A. Now, solving for A, remember A is a variable that we gave for the old rental amount, right? We would need to divide 73,984 by the 13,6. You could see it that way. Ultimately, it's going to leave us with A being 5440, the old rental amount. However, the adjustment is not for an old month's rent, it's for the new month's rent. So if we now grow A 5440 by 10%, we get the amount of 5984. That is 1 month at the new rate. And remember, because we have already received rental for July, this is the figure that we need to adjust by. So where do we go? We have to go to rent income. Rent income, as we said, was sitting at 73,984. And now we are subtracting 5984, the 1 month's received in advance. That leaves us with 68,000 the true amount of rental that should be reflected for this year. The other 5984 needs to get sent to income received in advance, or if you use deferred income. Hopefully you know that deferred income will be one of our trade and other payables, one of our liabilities, because we've received money that we should not really have received. It's not in our financial year. So that's a difficult adjustment, but one that you should be getting used to because it does pop up rather often. Number 6, depreciation is taken into account as follows. On equipment, 5220, great, we don't have to show any calculations here, it was just given to us. And on vehicles, 10% per annum on cost. Right, so if we go to our depreciation in our income statement, we would notice that the pre-adjustment does not have any depreciation yet. So we're going to have a new account under expenses for depreciation. The depreciation we've already got is on, I forget, was it equipment, I think, eh? So we've already got 5220 that we can put in brackets, and now we have to work out the depreciation on vehicles. So it's 10% per annum on cost. So if we go to our vehicles in our list of figures, vehicles is sitting at 147,000. So 10% of that is 14,700. We shouldn't really need a calculator for that. Meaning another 14,700 would go in depreciation's line. Where else would depreciation get shown? It would get shown in the fixed or tangible asset note, which we are not asked for in this task. So although we would do it, we're not required to do it in this activity. Moving on to the next adjustment, number 7. Interest on the fixed deposit must still be taken into account. Interest is not capitalized. 22,000 of the fixed deposit also matures on the 30th of November 2012. Be careful, this date falls within the next financial year. We'll talk about the 22,000 shortly. So interest on fixed deposit must still be taken into account. So if we go look at the fixed deposit figure in our list of figures, it says it's 84,000 and it's a 6% interest. So if we had to take 84,000 and times it by 6%, right, we would get a figure of 5,040. That would be the interest income we should get on our fixed deposit this year. However, if we go look for our interest on fixed deposit in our list of figures, we've already got 3,070 Rand interest on fixed deposit shown in our books. So it means that we don't have to process the full 5,040. We are only needing to process 1970 because we've already got 3,070 shown. So we were short by 1970, and that is the adjustment amount. So where do we go show this extra 1970? Because it's an interest income, we might need to go to interest income note. But because we weren't asked for it, we'll be able to do our adjustment in the interest income line in the income statement. So there we go, 3,070, what we had already in our books, plus the new 1970 leaves us with the 5040 we should get for interest income or interest on fixed deposit this year. Happy? The other adjustment, because you're not capitalizing your interest. When you don't capitalize your interest, you are waiting for some money. So you're going to treat this money as income accrued. There it is. Income accrued or accrued income from the interest on fixed deposit amounts to 1970 under trade and other receivables. Just remember, if it was capitalized, we would add the 1970 onto the fixed deposit, and that would appear in the balance sheet. The last sentence of this adjustment said that 22,000 Rand of the fixed deposit will mature within the next 12 months. Can you remember what you do? It now means that the 22,000 is not a non-current asset, but becomes a current asset because we'll be receiving this money within the next 12 months. If it's going to be a current asset, it means we are going to show the 22,000 as part of cash and cash equivalents. Happy? So here is my 22,000. I'll reveal the rest just now. But you can call it fixed deposit maturing, I'd rather say maturing, within the next 12 months, 22,000. It's now a short-term asset. In the balance sheet, if we were asked to do the balance sheet, our fixed deposit there would now no longer be sitting at 84,000. It would have to be reduced by 22,000 to take you to 62,000, which would be the non-current fixed asset or fixed deposit in the balance sheet. Okay, we're making good progress here. A few more to go. Number 8, included in the insurance amount of 5280 was the insurance on the owner's personal items. So 5280 is insurance on the owner's things, but that now needs to be kept separate from the business because of the business entity concept. So this means drawings is going to be used. It means then that insurance in our list of figures in the income statement needs to get adjusted. We should not be paying for the owner's private insurance. So 53,200, the insurance that was there, minus the 5280 will leave us with the corrected insurance figure. Drawings is also now impacted, and we should hopefully know that drawings will be part of owner's equity. Can you remember the wording or the layout of the owner's equity note? It starts off with balance at the beginning of the year, right? The next few lines, pretty much standard, would be first of all for the net profit for the year. You would then have maybe any additional capital or withdrawals possibly. And then drawings for the year would also be there before we get to the balance at the end of the year. So, drawings is what this adjustment is all about. We have already got drawings of 74,500, which I'll show you to prove it over here in our list of figures. There's drawing 74,500. So now on top of it is another 5280, leaving us with 79,780. And it's in brackets because it's going to reduce the value of owner's equity. And that was that adjustment. Happy? 3 to go. The secretary used petty cash to pay for stationery that she bought. 32 Rand, and this transaction was not recorded. Okay, so we have to take this information to 2 places. Where do you reckon we're going to go? Well, because they mentioned petty cash, we're probably going to go to petty cash. Petty cash is one of our cash and cash equivalents, and this payment from petty cash is going to cause a minus to petty cash. Petty cash, we can see in our list of figures at the bottom, was sitting at 500 Rand. We now would subtract 32 Rand from the petty cash to leave us at 468 Rand. The 32 Rand we paid for was for stationery, so we're going to now process stationery in our income statement. If you go look at your list of figures, starting at sales in the nominal, you'll notice that there's no stationery mentioned anywhere. We can't assume that we can simply put it in sundry. We should be told to do that. So we will now open up a new account in our nominal, and we're going to call it stationery over there for 32 Rand. Happy? 2 more adjustments. A physical count on the 29th of June revealed the following on hand. This adjustment always comes up. Firstly, trading stock 11,999. Can you remember what we do with that? Having counted 11,999, we go to the inventory note, and we simply go and put that 11,999 in the column over there, because that's the amount we've counted. However, we have to compare it with what our books are telling us we currently have. So 12,470 minus 350 tells us that our books thought we had 12,120 of trading stock, but we've only got 11,999. So if we compare the 12,120 with the 11,999, we'll realize that we are 121 Rand too much. We thought we had 121 Rand extra, but we actually only had 11,999. So we minus 121 in order to leave us with the 11,999, and that's not a good thing that's happened. Can you remember the adjustment now? The new account that needs to arrive. It's called trading stock deficit. It's going to be one of our new ends, our new expenses, and it's going to appear here in the income statement. And this is pretty much what we did on the last page. 12,470 was what trading stock was, minus 350 because the owner took stock to advertise, can you remember? And minus the counted 11,999 means that 121 had gone missing somehow, and we call it trading stock deficit. The other half of this adjustment says that 1073 of consumables was on hand still. In other words, we haven't used it. It's still sealed and unopened. So we should know pretty much standard is that inventories has a second line called consumable stores on hand. There it is. It arrives, you put your 1073 underneath your trading stock, and you can total your note number 1 in this case. The 1073, however, is telling you that you have not used consumable stores to the value of 1073. It means that the consumable stores figure in your list of figures there, 20010, is too big. You can't expense an amount that hasn't yet been used. So we go to our income statement, we go to consumables, or consumable stores if you like, and we'd have to process the amount by minusing this 1073. So 20010 minus 1073 leaves us with the correct amount of consumable stores that we've used this year. The last adjustment says that additional capital of 30,000 Rand was received and it was recorded during the year. So let's be very careful here. If we've received capital of 30,000 Rand and it was recorded, it means that this capital figure that we were given has already increased during the year by 30,000. So if we are going to go to the owner's equity note, the additional capital obviously would be the 30,000. But now how do we get the opening balance for the year? Well, if our capital is 716,616 and it's already gone up by 30,000, we would have to minus 30,000 to find out what our capital was at the start of the year. Happy? So we're working back. While we're here at the owner's equity note, we can't yet do the net profit for the year because we haven't finalized the income statement. So we'll come back to that. Just to confirm, we've completed all our adjustments, and now it's just left for us just to clean things up and finalize our income statement. So first of all, looking at the top few rows, sales and cost of sales and gross profit are the first few nominals in our pre-adjustment trial balance. And we haven't had to affect or change either of those ones there. Can you remember where debtors allowances goes in our income statement? Debtors allowances gets closed off to sales. So you're going to find 698,590 minus 12,750 in the sales row. We'll then have 312,400 for cost of sales, and together, once we've subtracted cost of sales, it'll give us the gross profit. There we go. Do you see? You're subtracting the amount of debtors allowances off from the sales amount. Happy? Discount received is an income that we haven't had to mess around with. So looking at our list of figures, there's discount received on the top of the screen, 25530, which means we can go put it here, 25530. Happy? So those are all the incomes. We can total our incomes above them there. How do we get gross operating income? Gross operating income is this gross profit over there plus the other operating income, and that's how we're going to get gross operating income over there. Operating expenses has got a few gaps. So these gaps, these lines that we haven't had to change, simply are going to come from our list of figures in our nominal section. So you could pause the video and just double check me here, but all the ones that we have not changed will now rock up here over there. Those 5 of them, it looks like, would arrive. Happy? We can total all of our expenses and put the total above. The next figure in our income statement is the operating profit, which we get by saying gross operating income minus all our expenses would give us our operating profit over there. Great. The last few lines of our income statement speaks of profit before interest expense, which is simply the 2 lines above it added together. Interest expense, we haven't had to deal with interest expense, but looking at our list of figures, interest on overdraft is an interest expense. It would have gone to the note number 2, interest expense, but because we're not asked for that note, we can simply put the 8750, yes, in that brackets because we're subtracting, and therefore, after all that, our net profit for the year is 27,867. Where does that net profit get taken to? I mentioned just now that the net profit would go to owner's equity in the only line that's missing. There we go. So that's usually a principal mark. So whatever you got, even if you made a mistake and got a wrong net profit, if you brought it through here, you'd get the mark. Happy. So the only thing left here in owner's equity while we're still here is to work out the closing balance, which would have been the opening balance plus the net profit plus the 30 grand of capital that was added minus drawings, leaving us with the closing owner's equity there. Just to clean up some of our notes, we've already done inventories. Trade and other receivables we also finished with, so we could put the little total over there just to be done with the note number 2 there. Cash and cash equivalents has got 2 gaps here. What amounts here, or accounts rather, would go to cash and cash equivalents? Notice here, I'm sure some of you would have been tempted to put bank there. Why can't we put bank in cash and cash equivalents? Because it's a credit. In other words, it's an overdraft. And bank overdraft must get shown on the face of the balance sheet. So, the other 2 would be cash float and savings account. 15,000 for savings and 500 Rand for cash float. And we'd be able to put those in the 2 columns over there. And cash equivalents is done. The other note we had to do was trade and other payables, and we haven't had to change trade creditors or creditors control, which in our list of figures was just over 101,000. So we can bring that figure over there and we can total the note like that. Happy. So this is a full income statement and quite a few of the notes. It was a task or an activity worth about 80 marks. There we go. And hopefully as you work through these adjustments, you felt good about it. Hopefully, if you've got any assessments coming up, hopefully this video assisted you. I'll hopefully load up a few more, and all the best with your accounting studies. Good luck.